My next guest remains bullish on the market near term, but says that these hostilities are a headwind. I'm going to bring in now Turtle Creek Advisors, the chief market strategist, David Spika. David, let's talk about this because we really felt like we were at least hoping, right? I don't know if anybody that's 100% convinced, but we were hoping. Crude went to 68, West Texas Intermediate. Maybe we could put that behind us. And it did feel like we had the wind in our backs, and now it's starting to be a problem.
Absolutely, it's a problem. So as long as there's fighting in Iran, you're going to have oil prices elevated, interest rates are going to be elevated, and that's going to be a headwind for the economy and for earnings growth. The other thing I'd point out, Charles, in terms of potential headwinds are we're probably peaking in terms of earnings and revenue this quarter. Earnings growth is estimated at 31% over the next 12 months. The only time we've ever seen that kind of 12-month forward earnings growth was coming out of the 2008 financial crisis and coming out of COVID. So you need to start thinking about other opportunities in the market.
Now, I will also pick up on that. This is the best earnings period we've ever had, not coming out of a recession.
Exactly.
Because those were associated with recession. Right. So does that make this a little bit different then? Maybe, do we have to, say, okay, the timelines are the same? Is there something about this particular move here? Maybe just the generational opportunity with AI that could make a difference.
AI CapEx is absolutely the difference, and that's fueling what's going on in this market. Another statistic that gives me a little bit of pause is second quarter earnings growth. 20 companies are going to account for 95% of second quarter earnings growth, with Micron and NVIDIA accounting for 40%.
Right. Then throw Chevron in there, that might be up to 60%. I want to ask you then about this. So July's been sort of a reset, right? July, all the momentum industries, industrials, tech, materials, they're down, although they're up for the year, which is are on the right-hand side there. The ones that have done well, energy, financials, real estate, you kind of like this, right? You kind of think that this rotation is not just a blip, but this is maybe where investors should take their cue.
Well, I'm not trying to time the market or pick certain sectors, but I do think there are great companies in other sectors outside of AI-related tech, et cetera, that deserve another look. And we've got a few of those we like today.
All right, so let's start with financials, because JP Morgan is one. Well, actually, we'll start with Johnson & Johnson.
Okay.
We'll start with the healthcare. Well, it's a wonderful chart, and there is true excitement there, whether it's from the GLP-1s and some of the other things. And it feels like it's moved on beyond just Lilly.
Yeah, you can see that healthcare names, and J&J in particular, had a long period there where they weren't really keeping pace, and now there's been a big jump. J&J had a great quarterly result. Earnings and revenue were up. It's also compounding revenue and earnings and dividends at a very radical rate, cash flow as well. And there are a great pipeline there. It's not just about the GLP-1 drugs. There's a great pipeline of drugs there, and they've got their med tech business too.
And because we also have been hearing about this sort of cliff, this patent cliff in this industry, and maybe that's why biotechs have done so well. But you don't think they have to be worried about that, though?
No, their pipeline is very stout. And again, you look at the med tech business, they spun off the orthopedic part of that. Now they're investing in cardiovascular. That's another growth engine for J&J.
All right. Now I think we're going to get JP Morgan.
Okay.
What can you say? The stock is broken out to your, same sort of scenario. It was threading there a little bit, these key moving averages. I'm not sure it lived up to the hype at the beginning of the year, because it felt like everyone said financials. It's living up to the hype now.
Well, we're getting the steeper yield curve, which always favors the banks. We've got great investment banking results. You've seen very good consumer and commercial banking results, and they've also got the wealth management business. But again, a very strong company with a very solid balance sheet that's returning capital to shareholders and has an excellent outlook over the next.
All these banks are saying that consumers are doing okay. Are you surprised at that? I mean, no one said anything negative about it. I think Capital One this morning had something positive to say about it. Maybe Bank of America. They're not saying anything negative about the consumer, despite the fact we keep hearing about inflation pressures and things.
I think there's enough consumers in that top 10% that are carrying the entire consumer class to drive those kind of comments.
All right. EOG, which is the only part of Enron that survived, it's a wonderful looking chart. Here's my concern. What happens if we do resolve the Iran war? What happens if, this time it sticks? Because it was running like crazy. All of a sudden, it looked like, it pulled back. You like this as a buy here, though?
I do, and that's a great question, Charles. So today we got WTI at 86. EOG's break-even level for WTI is $50 a barrel. So there's a lot of cushion. Plus, they're doing a lot of LNG production too. What was the news out of Europe this morning? They're running out of natural gas. They need the LNG. And EOG also is returning 70% of their free cash flow to shareholders this year. So they're doing the right thing there. So again, it is a play on what's happening in Iran. It is a bit of a hedge against that. But longer term, we still like the name.
Great stuff, David. Really appreciate it.
Thank you
very much.
You bet.
All right, folks.